Welcome to The Explainer. Today we're diving into Michael Saylor's really ambitious vision for using Bitcoin to basically build a brand new credit system from scratch. It's a huge idea, so let's jump right in. So first, let's just tackle the elephant in the room. You hear a lot of chatter, a lot of bearishness out there, maybe some frustration as the price just kind of chops sideways. But what does the data that Saylor points to actually tell us? Now, if you just zoom out 1 year, Bitcoin is up nearly 100%. I mean, as Saylor says, if you told anyone on the street your main asset was growing that fast, they tell you to stop complaining. This performance, it really throws a wrench in that short-term, day-to-day doom and gloom narrative. Okay, so here's our game plan. First, we're going to tackle a major criticism from the old school finance world. Then we'll look at what's wrong with the current system, unveil Saylor's blueprint for a new one, see how it's actually being built, and then we'll look at the grand vision for the future. Right, so the biggest knock you hear from the old guard, the traditional finance world, is that Bitcoin can't possibly be a serious investment. Why? Because it doesn't generate any cash flows. And this idea, it's basically been the gospel for the last 2 generations, especially after 1971 when we left the gold standard. The whole world just got laser focused on stocks and bonds, things that pay you a coupon or a dividend. But this is where Saylor just completely flips the whole argument on its head. He says, hold on, let's look beyond the last 50 years. What has humanity actually valued the most throughout history? I mean, just think about this list for a second. Gold, diamonds, priceless works of art, huge tracts of land. None of them have cash flows. Your house doesn't. A Nobel Prize definitely doesn't. In fact, Saylor's point is that the perfect form of money should have the least amount of other uses, because any other utility just makes it a commodity, not pure money. And that brings us to his next big point. He argues the real problem here isn't with Bitcoin at all. The problem is a deep, fundamental weakness within the traditional credit system itself. He doesn't mince words. He calls it weak and unhealthy. His diagnosis is that the whole system is suffering from something he calls monetary repression. In plain English, the yields you can earn are always lower than the rate at which money is being created. So your money is literally losing purchasing power, even when it's supposedly invested. And wow, looking at government yields really makes it obvious. In Switzerland, you're actually paying the bank to hold your money. In Japan and Europe, the yields are practically zero. And yeah, even in the US with a 4% yield, that return often can't keep up with how fast things you actually want, like a house or stocks, are going up in price. This is what he means when he says we're living in a yield-starved world. Okay, so if the old system is broken, what's the new blueprint? Well, it all kicks off by totally redefining what we mean by capital and credit in this new digital age. So the first big principle here is to stop thinking of Bitcoin as a currency to buy a cup of coffee. Instead, you need to see it as the world's best collateral. Saylor calls this digital capital. It's an asset that he believes is engineered to appreciate faster than just about anything else over the long haul. And here's the second piece of the puzzle, and it's absolutely crucial. Once you have this perfect digital capital, you can build a whole new class of credit on top of it. He calls these instruments digital credit, and they can offer much higher yields for much longer, and get this, they're massively over-collateralized, which actually makes them potentially safer than old-school bonds. Now, you might be thinking, okay, this all sounds great in theory, but is anyone actually doing this? And the answer is yes. Saylor's own company, MicroStrategy, has already started building this out, creating a real-world example of what these new credit instruments look like. They've created 4 different products, each for a different kind of investor. You've got Strike, which gives you some yield plus a piece of the upside. Strife is senior debt. It's the safest, first in line to get paid back. Stride is junior debt, so it offers a higher yield for taking a bit more risk. And then there's Stretch, which is designed to be super low volatility, kind of like a money market account. And this right here shows you the flywheel, the engine that makes this all work. So they issue an instrument like Stride to investors who want that high yield. They take the cash from that sale and immediately buy more Bitcoin. That new Bitcoin makes the collateral pool bigger for all the instruments, making them all safer, and it drives up the company's equity value. It's this beautiful, virtuous cycle. Okay, so this is the number one question everyone asks. If you don't sell the Bitcoin, where does the money come from to pay the yield? And Saylor's method is actually pretty simple. His company raises a ton of money in the equity markets. They just set aside a tiny fraction of that new cash, we're talking like 5%, to pay the dividends, and the other 95% goes right into buying more Bitcoin.
All right, let's zoom all the way out now and look at the massive picture Saylor is painting for the entire financial world over the next decade. This is the grand vision.
He calls the decade between 2025 and 2035 a digital gold rush. He expects it to be a chaotic, messy, but unbelievably creative and transformative time, kind of like the early days of the oil boom. You're going to see whole new business models and products pop up, fortunes will be made, and yeah, mistakes will happen. But the end result will be a totally reshaped financial world.
And for Saylor, this whole thing goes way beyond just finance. You can see he views Bitcoin as more than just better collateral. He sees it as this foundational technology for more honest, a more fair, and a less divisive world, a kind of neutral ground where we can settle our differences peacefully.
So this leaves us with a really powerful final thought to chew on. If this model works, if using perfect digital capital to create superior digital credit actually scales, it doesn't just create some new niche asset class. It fundamentally challenges the entire value proposition of every single traditional financial instrument on the planet.